Welcome to Startup Success, the podcast for startup founders and investors. Here you'll find stories of success from others in the trenches as they work to scale some of the fastest growing startups in the world. Stories that will help you in your own journey. Startup Success starts now.
Welcome to Startup Success. Today we have Gaurav Bhasin, who is the Managing Director of Allied Advisors with us today. Welcome.
Thank you, Kate, for having me. Pleasure
Thank
to
you
be
for
here.
being here. I'm a big fan of the content, and we'll get into this later, that Allied Advisors puts out, and we'll talk about that in a bit. But let's start with just an overview for the listeners of what Allied Advisors does, your role there, and walk us through.
Yeah, so, Kate, I'll start with my role, and that will kind of lead to how I started Allied and what we do. So, just a bit about my background. I've been in the tech space for a little over 20 years. Not always a banker. I actually was an engineer for a few years, moved to a management role. And I think that experience was pretty valuable because, it kind of gave me a good sense of how companies work, how do they build products, how do they sell products. So when we work with a client, some of that sort of, empathy kind of seeps into our projects. After business school, I moved to investment banking. I've done that for over 17 years. I worked at Bank of America Securities. We did IPO, M&A, and debt deals. Even back then, the deals were at least $500 million or more. While I enjoyed the experience, my heart was always kind of in mid-market M&A, which is broadly speaking, 20 million to 200 million exit value. And that's what I've done for the last 30 plus years. I was at two different firms, both of which were successful, both of which got sold. One got sold to a larger firm, Duff and Phelps. I was the managing director there, stayed for about 4 years. Another one also got sold. I stayed for about a year post-transaction. My experience is when firms get sold, sometimes the core focus sort of changes. And I felt that, the firms kind of want to go upstream and do some different things, and the level of senior attention goes away. And I saw that there was a market opportunity, frankly, to go serve mid-market technology companies with senior attention, which is what I love doing at these other firms. And that's what sort of prompted me to start Allied Advisors. And my wife kind of nudged me on it too, saying, hey, there's all these clients, you can kind of serve them better in an entrepreneurial environment. And that's what led to me starting Allied Advisors in 2019.
That's great. And your background is perfect. Like you said, it really lends itself to what you're doing. And then the fact that you have a passion for it is an excellent combination.
Thank you. Really appreciate that. So I'll tell you a bit about Allied Advisors. So we started the firm in 2019. What we do is we focus on B2B software businesses. About 85% of our workflow is on SaaS clients. They are generally private companies. We focus on middle market. So broadly speaking, they can go anywhere from 20 million exit value to 200 million exit value. We do a little bit of deep tech, so we'll do some AI ML deals, but by and large, think of us as a software M&A and capital raise firm. Some of our partners, like another partner of mine, he's Chicago MBA, Goldman Sachs, 20 years in the industry. He has a corp dev background, also an engineer by training. Another partner is MIT grad, an entrepreneur. So the beauty of this is, we've kind of been in the client shoes. We've been at firms where we have bought companies, we have advised companies before, and that gives us a kind of a unique advantage in how we sort of position these clients to the different buyers. Since we started the firm in 2019, we have closed over 20 transactions, which is remarkable.
Mhm.
As you know, the last 4 or 5 years have been choppy, right? You had the COVID boom, COVID bust.
Yes.
You've had this prolonged downturn, but despite that, we've been steadily closing transactions. So some of our clients, we help them sell to guys like IBM and American Icon, some leading AI companies like Alteryx. We sold a software company to Walmart. It's a Fortune 1 company. We sold a AI ML company to Activision Blizzard King. They're the makers of Candy Crush. I'm sure you play that game. And then we have also sold a software company to Deloitte, the biggest IT consulting company in the world. Sold an AI company to Elsevier, which is a big FTSE 50 company up in Europe. We have done deals with private equity firms like K1 Capital, Fransco Partners, Clear Lake. We just sold a company to Providence Strategic Growth 3 months ago, and we had multiple bids on that deal. So, top tier names, we have sold it to Fortune 50 companies, top tier funds, and some of our work has been picked up in Wall Street Journal, Barron's, TechCrunch, and even your from Berkeley was kind enough to distribute a report, vertical SaaS versus horizontal SaaS. So, we're having fun doing this, and this is fun doing it in an entrepreneurial way.
Wow, remarkable. I mean, the list of some of the transactions you just went through, I mean, super impressive. Also sounds like it would be really fun. I mean,
It can be
right?
exhausting, but it's nice to get the clients
Yeah,
over the finish line. And we are thankful
yeah,
for the opportunity to work with them on,
I
frankly, the
bet.
most important transaction in the company's life cycle. The exit is a pretty important milestone for any founder, any
Mhm.
investor, and being part of those processes are important to us, and we are thankful to be part of those.
I bet. I bet.
Yeah,
And what recently caught my eye, I've been familiar with the work you've been doing for a while, but you just wrote an article for Crunchbase
yeah,
about PE investment and how a
sure.
company should approach it when a PE firm is interested. If you could walk us through a little of that, because I know so many founders, companies that are in that position in this market right now.
Yeah, absolutely. So, I've been doing this for 17 years. Earlier PE was in our processes probably 10-15% of the time, and we're putting on an M&A report, and you will see the private equity folks are in about 40% of SaaS deals. So there's been about 1.5 to 2 trillion of capital raised, whether you look at PitchBook or some other data sources. The private equity guys love SaaS businesses. They are recurring businesses, high gross margin. So a lot of capital has gone into these private equity firms. What that means is, as a founder, you have a lot of capital chasing you, which is a good problem to have. That means you can dictate your terms, and I think that's in a good place to be. So, given this much amount of private equity, they also know they want to try to get into these deals early at a discount. Frankly, because they know other private equity firms are kind of chasing the same founder, same entrepreneur, same type of company. So what they've done strategically is they've hired these young, smart college grads, which are 2, 3 years out of school, as business development folks or associates. And these folks constantly ping founders, CEOs saying, can we have a chat? Love to learn a bit about you. Now, this is my advice, when the founder, CEO get these kind of emails is, take some of those calls, but try to keep it short, 15 minutes. Otherwise, these can be major time sinks. You got a business to run.
Hmm.
So, and there are a lot of firms that will chase you. When you have these calls, quickly ask them what size of deals they invest in, what sectors they invest in, and why did they reach out. That will tell you if they're a good fit or not. If you're a 10 million ARR company and if Carlyle reaches out, you should be flattered, but Carlyle is not the right buyer for you.
Hmm.
So you got to figure out, who is the right private equity firm that reached out, why they're looking to invest. Ask them right questions. And also be careful that the associate or the business development person is not going to make a decision. It's going to be the partner that's going to make a decision. But they are gatekeepers to the partners. They'll ask you questions. You may want to tell them a little bit about your revenue, a little bit about the EBITDA, historic stuff, nothing in the future. And I'll tell you why. Because if you give them a projections, they'll put this into the CRM. They'll approach you a year later and they will see, hey, wait a minute. You said you were going to do 20 million, you ended up doing 14. What happened, right? It hurts your credibility, hurts your valuation. And more importantly, they're trying to get some information in the space. They may be talking to your competition. Why do you want to expose that information out? So my suggestion is give them just the very little, just make sure they're fit or not. You will know in 15 minutes if they are or not. And then tell them, they might say, let's get further. You say, look, I'm getting approached by others. I will run a process sometime. I will hire a banker. They might say, why are you hiring a banker? Just deal with me directly. Private equity guys say that all the time, but when they sell their own companies, they always hire a banker because they want to get best value. But when they want to buy a company, they prefer not to have a banker. So, get the list there. At some point, my advice to founders is engage a banker, whether it's us or someone else. The banker will give you, based on your industry, your size, like we have a big 1,000+ private equity firms in database. If you're 20 million ARR company, we know which private equity firms to go to. If you're 10, we know which private equity firms to go to. We can help you figure out, which private equity firms to approach, which not to approach, which ones change price during a process, right?
Hmm.
Which ones try to do retrade. You as a founder may want to keep majority control. Well, there are firms that do minority investments. And then when we run a process, we try to get them to put bids by indication date. So they'll put in the bids. We'll help you walk through because there's a lot that goes beyond just the valuation. You have to figure out, is it a majority deal? Is it a minority deal? Are you having to roll over your shares? Is it earn out? There are a lot of bells and whistles involved. And the private equity folks are, I would say, financial jockeys. So you
Mhm.
want to make sure you're kind of well represented with someone who can speak their language, can represent you well. And I would say having a firm like Berkland here will be very, very valuable because a lot of the founders and CEOs of companies sometimes get by with basic financial support, right? If they don't have a CFO in house, consider getting a firm like Berkland on board just so you have all the financial metrics in place. You can give them customer retention data, have the financial statement dashboards ready to go. I think all of that will help you in creating value. So my suggestion is take those calls, give them just enough to keep them excited, quickly filter them out if they make sense or not. And you should run a process because that's how you're going to get maximum value. And there's a lot of private equity firms there. We're going to be putting out a report in about 2 weeks, M&A in today's market, and you will see some of the data there. Like private equity is doing a lot of deals. They bought Coupa Software recently. They bought Qualtrics, and they're also doing a lot of deals in the lower mid market. So
That was so helpful because
thank
there
you.
is so much going on with private equity right now. And I like how you walked us through from that first phone call because you're right, from the startups I've
Sure.
worked at, it's always an associate. And you're right, they always start asking about future.
Yep.
And and just the way you spelled it out, and then how you need to get a banker and you need to think about your financials and ownership. It's that was really, really helpful because I've seen some not so positive outcomes with private equity investment. I mean, let's be honest. So I think you flagged a lot of things that people need to be paying attention to.
Yeah, that's a good point, Kate. Sometimes private equity gets a bad rap. And one of the other things, we recommend is if you take a term sheet from somebody, right, it's almost like getting into a marriage. In fact, in some ways, you can get out of a marriage, but you can't get an investor out of a cap
Mm-hmm.
table. So
Mm-hmm.
you got to be very careful who you bring into your company you built over 5, 10, 15 years. And also, before you sign the term sheet, we even sometimes have our clients go talk to some of the founders they've invested in and figure out how this has worked out for them over the next 5 years. Did their rollover share become 3x, 5x? The second bite of the apple, was it bigger than the first bite? Did they pay them in the earnout? Were they value add investors? Did they help them in the go to market? Did they help them in recruiting? All the things they said they would do. Did their revenue increase? Did their EBITDA increase? So, we kind of help you kind of ask those questions, some of which you may not even know what to ask.
Mm-hmm.
We'll kind of help you that. We'll also help you answer the questions crisply, what the private equity guys will ask you. So we kind of become a friend, a coach, a partner along the way because we want the best outcome for the founders.
You need that. And what an excellent suggestion to talk to other founders they've invested in because there's a lot of talk, right,
Yep,
during the deal. It all
sure.
sounds so good. That's excellent. So how does this compare to like an M&A deal? Because those, just the consensus out there with a lot of people is just a better outcome, right? Let's be honest. So walk us through that and why people think that way. And that would be really helpful.
Yeah, at the end of the day, strategics, I would say 90% of the time, and I say 90%, by and large, end up paying more than private equity, right? I mean,
Hmm.
private equity over the 5 year period may be a better outcome because your rollover shares, if you roll 20, 30% of the deal, may become 3 to 5x. So you may make more. But by and large, if you're looking at upfront value, strategics like if Google buys you or Microsoft
Hmm.
buys you, they'll end up paying you a lot and you'll make a lot of money through stock and other things there. So, I think, first of all, as a founder or a CEO of a venture backed company or a bootstrap company in this market, there are a couple of things you need to be aware of, right? If you're a venture backed company, talk to your board, make sure everyone is aligned before
Hmm.
you start a process. Like, hey, guys, I think the market is changing. I think we are better off going with a bigger company, which has sales distribution. They can grow us faster. We can raise money, but it may be better to just exit out. We're getting approached. Let's run our process. Make sure they are aligned with you because you will need the support through the process. So first, have that discussion. And sophisticated founders, sophisticated CEOs do that. Get everyone on board, so everyone on the same table. And then, if you've raised money in 2018, 2019, 2020, you might have raised a 50x, 100x ARR. Well, good for you. But the challenge is today's market, you're probably not going to get that multiple. The SaaS multiples used to be 15x, they gone to 6x. So, if you have grown nicely, then maybe you can command, those 30, 40x multiples. But if you haven't, chances are that your multiples will be more in line with today's market. If that's what happens, look at scenarios, get a banker on board or get advice on board. Okay, talk to the board and the founder and say, okay, based on where you are, where the market is, this is where you might exit at. And then look at your liquidation preference. If you raised a lot of money, if the value of the exit is lower than liquidation preference, the chance of the CEO and founder is going to make nothing. And that's not a situation you want to be in. And investors generally, by and large, are thoughtful because they know they're kind of investing in a bunch of companies. They want good for the founders. Maybe have a chat with them before you go in the process. Hey, if my exit proceeds is less than my liquidation preference, can I get a carve out? Because at the end of the day, the way I look at it is a symbiotic relationship. Founder CEOs are driving the bus, investor putting gas in the car, guiding them. One can't do without the other. So you want to make sure that you both align so that come exit time, if there's a scenario where unfortunately you have grown but not as much as your valuation suggested, everyone is still happy. Founders make some money because they spend their time on it. Investors get an exit, which helps them recycle capital, give money back to the LPs, and you can have a good outcome. So that's one. And then, when you kind of go through the process, what I would say is if you were the banker, what we would do is we would want to sit down with you, find out your goals. We would come up with a buyer list. You would have your names. We would have our names. We would talk to you about why a certain buyer would have interest or not have interest. One of the things we also recommend to CEOs and founders is build relationship with these strategics early because they move slowly. Private equity moves like a rocket because they have nothing to do other than buy companies and sell companies and grow companies. Strategics, on the other hand, have to report to shareholders. They got to hire people. They got to, sell products. They got to do all these things. And then M&A is like 10% of the activity. Private equity is like 100% of the activity. So build these relationships early. So when a banker calls them, there's already somebody who's kind of working in the commercial partnership or maybe has invested in you. Those transactions, in my experience, go a lot better. I actually wrote an article in this that Forbes picked up. It's on a website. You can, founders are encouraged to read it. But if you have the relationship, that helps. Then what we do is we kind of put together a offering memorandum of the company, like what's attractive about the company, why should you buy it? What are the differentiators? Talk about the team, the tech, the product, the revenue, the go-to-market. We also talk about, synergies. For example, now that everyone is saying be break even or cash flow positive. Well, if you're burning money, we look at something areas where you can cut costs. Like buyers probably don't want your finance team. Hopefully using Berkland, so Berkland can phase away, but they've done a good job. They don't want HR. I mean, they have got good HR people. They probably have better salespeople than you, no offense. So put the cost there. Customer success, they probably have an army of customer success team. And then, there are other costs like cloud costs and software costs, which you can reduce under buyer. So we actually put together synergy models that show, okay, under day zero, post acquisition, all these costs can be stripped out. Again, we rely on the company to provide financial, but again, a firm like Berkland can be super helpful, because you can produce scripts, three-statement financial model, NRR data, net retention data, gross retention data, how does your margins look like, all that good stuff. So packaged correctly. We help our clients put together data rooms. In the data rooms, we'll put together a cap table, a clean cap table that shows how much has gone in, who the ownership is. Make sure assignment of IP is done by all your developers. So that way the buyer is not chasing you or you're not chasing some developer who worked on the product because buyer is not going to sign off on the deal otherwise. We make sure the customer vendor contracts and everything else is in there. We actually have a fairly good list of pre-LOI, which we send to a client. So when buyers are interested, we kind of let them go in there and they can look at it. And that also builds kind of buyer confidence. So there are many things we kind of do to make sure the process goes well. And then we reach out broad. In this market, you're well served to reach broad. As you know, different buyers have different ability to pay, different perceived synergies. We have been in transactions where some buyers offer 3x the value another buyer has. And that's the way you as a founder will optimize your value. If you just negotiate with one, you're frankly hurting yourself. And, if you and I were to sell a house in the Bay Area, Kate, we would definitely try to market to as many people as possible versus just trying to sell to one. I think that's where you get the optimal value. So.
That was so interesting because I've been through some M&As and you hit on everything like the alignment, which is so
Yep.
important, the building relationships early, which when you talk to these people, that was a key component. But I love how you talked about the synergies, like, with HR and sales and service delivery and how you help founders with that, because I think
Sure.
that's a big component that can really help deals when you align like that. And just how you compared it to private equity, that it's a lot slower, it's a much different process. I think that was really helpful for people listening. Thank you. In the
And
beginning, oh, go
and
ahead.
yeah, just one more thing I'll add in this market, especially, is try to make sure you have 9 months to 12 months of runway, because
Oh,
sometimes we have clients come to us and say, hey, we have 3 months of runway. And in that case, we we kind of give them guidance, but we generally don't take them on because M&A processes take a while. It's like having a
right,
baby. It takes
right.
9 months, and it used to be 6 months, but now it's like 9 to 12 months. And just make sure you have enough cash to do the process, and buyers see that, right? If they see you're low on
Right.
cash, they can take advantage. Even strategics do that. So that's one piece of advice in this environment. So
That's an excellent point to bring up because there's the desperation when you don't have the cash,
exactly,
right? You're out of
exactly.
options and they know that right away.
Yep,
Absolutely. And let's talk about that because you mentioned the market a couple times, the fundraising market.
sure.
Today's fundraising market's completely changed. It's everyone describes it differently. What are your thoughts on the fundraising market?
Yeah, so it's not like it was in 2020 where, almost anything that moved and was a company and did something was getting a term sheet. Well, that's extreme, but, it's not quite there. I think today's market has changed dramatically and drastically. I think, a couple of sectors are in vogue, AI, but again, keep in mind, there's a lot of AI companies. Some companies are sucking in all the oxygen and all the capital, and there are a lot of wannabes which don't get the capital. Security is resilient, still getting funded. Repeat founders get funded because they've been through that cycle before, inception to exit. They're hardened. They know pitfalls to avoid, things to kind of grow the company. So they are in vogue. If you look at Series D, that had completely created, right? Because after Series D, Series E, next step was to go public. But they were funding these companies at 30x ARR, and the public market, if you look at Bessemer SaaS index, fell from 15 to 6. So, how can you go public with a 30x multiple and the public markets are 6 and they haven't performed well, and SPACs gave a bad name to the public markets, right? Good news is the Series D is improving. Databricks is in talks to raise funding at 41 billion. The last was 38. So it's going to be a step up. So I think that's good. Hopefully Klaviyo, which is profitable, ARM and Instacart, they all go public nicely. That'll help the Series D market. So I think that's going to improve. I think if you look at Series A, earlier you could be $1 million company and you could get a million ARR and you could get
Mhm.
50 million valuation. Those days have changed. Now investors will look for 2 to 3 million. And they're also going to look at not growth at all costs. They're going to look at, are you rule of 40? Are you close to break even? Are you profitable growth? So they're going to put all the bells and whistles, right? And that's where firms like Buckland can, you know, put those metrics in place so that we are more attractive to a Series A investor. And C, it didn't change as much because seed, has typically 8-year horizon, right, for exit to funding. So they were still kind of active. And if you look globally at the Carter report, Carter said that Q2 was better than Q1, up 26%. So that's a positive. I think the down rounds increased to 20%. And I think that's a positive because you know why? Because sellers' expectations are moderated. And that will lead to more deal flow. They're not holding back to 2020 numbers, 2021 numbers. They're kind of like, no, this is a new market. So that down rounds is helpful. It'll get deals done. And then, investor friendly term like liquidation multipliers have kind of come down per carta, which is also good. And, I had some investors in my house for dinner last week, and he said, look, now I'm kind of thrilled to invest because earlier these investors like Tiger and Sequoia were, not, sorry, Tiger and SoftBank were putting term sheets at such insane valuations. I just couldn't compete. But now these guys are like, I have the capital, I've got fresh capital, so I'll deploy. So long term, I think, it's improved. It's not as easy as it was 2020, but I think there's some positives we are seeing happen, which I think is going to be good for founders and entrepreneurs.
We're seeing that as well. We're seeing the shifts
Yeah.
that you talked about, and it's nice to see. And that brings me to you've shared such phenomenal insight today. I want to talk about all the resources you have on your website and
Sure.
where founders can go, because you have so many great blog posts and articles there. I go there all the time,
Thank
like
you.
around SaaS metrics and, fundraising. So if you could, tell us your web URL and give us a little overview of what you have, the resources there, that would be great.
Yeah, I appreciate that, Kate. So when COVID hit, I wasn't traveling as much, and oftentimes earlier in my career as a banker, I always wanted to kind of think of things, but I never found reports. So I was like, what if there was a report? Everyone talks about vertical SaaS being better than horizontal SaaS. Well, why is it? So we wrote a blog on it, and a lot of people loved it. Then rule of 40, why does it matter? Well, we wrote a blog, and you can see the valuation differences between the company that follow rule of 40 versus that don't, across 12 different sectors. Then, we looked at SMB SaaS. Like, why should you care? It's a neglected child. Well, you should care. There's some interesting aspects. We write stuff about things that happen in M&A deals, or stuff which is happening in the market. We are just putting out a simple blog post in a week or two on gross margin and why you should care, right? So we try to put report which is differentiated, which is not something you kind of get in mainstream. It's more our years of experience that kind of come in. We just put out a report on how to prepare for M&A. Big report. It's a big read over the weekend or a cup of coffee. Hopefully you get some out of it. But I think when we do our transactions, we say, what can we write that may be of interest? Like we were doing a lot of deals where, our clients had folks in different countries. And we said, let's write a blog on outsourcing and the value it can bring in an M&A process, right? So we try to be creative. We try to be thoughtful. We try to, we also learn, frankly, by writing this because we have to do our own research. And our goal is hopefully founders, entrepreneurs, investors resonate. And, we have gotten good compliments from even big buyers, strategic buyers. They're like, your report's very different from the banks because there's cookie cutter, it's just transaction comps and public comps. And you actually write reports that, I think educate the market. So we enjoy doing that. We'll do more of it. We don't put it in a lock and key. And our goal is, to learn and, share the education with others, what we learn along the way.
That's great to pay it forward like that. And it's excellent content. And like my conversation with you today, the content, it really shows the expertise and the knowledge that Allied Advisors is bringing. I mean, it's
Yeah.
seriously, it's really exciting. So if I'm listening and I'm interested in using your services, want to get in touch, what's the best way to do that?
Yeah, so you can either send me an email or you can go to a website. It's called Allied Advisors with a E, rs.com. And my email is just my last name, BHASIN at alliedadvisors.com. So, or you can send us an email through a website and one of us will get in touch with you.
Excellent. Thank you so much. We could, pick your brain for hours here. I know the founders listening, got a lot of insight. So thanks for being here today and making the time.
Thanks, Kate, for inviting. Really fun talking to you.
You've been listening to Startup Success. To make sure you don't miss out on future episodes, subscribe to the show in your favorite podcast player. Like what you hear? Tap the number of stars you think the show deserves in Apple Podcasts. For more tools and resources for your own startup success, check out birkelandassociates.com. Thank you so much for listening. Until next time.